Good afternoon students, again welcoming you to the new session, that is classifying financial markets. This is Dr. Priyank Sharma from School of Management Studies, Swami Rama Himalayan University. So in the today's session we will talk about the classification of the financial market, and let's have an overview of the particular market. Okay, so in this session we are going to explore a topic that's foundational to understanding finance and economics, that is the classification of financial markets. So we need to understand why it is important, because financial markets are everywhere. Whether you are an investor, a business owner, or simply a consumer, the health and functions of these markets affect our economy, our jobs, and ultimately our lives. So by the end of today's session, you all understand the different types of financial markets based on what's traded, how they operate, and where they operate globally. We will also discuss real world examples to make these ideas more concrete and understandable. So let's start by stepping back and asking what exactly are financial markets and why do they matter to us. So the role of financial market is, as we know, that what they used to do, they used to mobilize the savings. So as its core, the financial market is a place, physically or virtual, that means that can be a physical market or that can be a virtual market, where buyers and sellers meet together to exchange financial assets. Okay, so these markets are lifeblood of modern economy actually, because if we don't have the markets, then how we will trade these products? So they connect savers who have excess funds with business and governments who need the capital to grow and invest. So they serve the three essential functions. What these financial market three essential functions? First is mobilization of savings. Instead of money sitting idle in a piggy bank, financial market channelize it into productive uses. What are the productive uses? Like when you invest in a stock or a bond, your money helps a company to build new factories, develop new products, or hire more workers. This is critical for the economic growth, that is required for the economic growth. Second, it also helps in price discovery. So what is that? So financial markets helps to determine the price of assets based on supply and demand. So if a company is doing well and investors expect it to grow, its stock price will rise. Conversely, poor performance or negative news can push prices down of share markets. This dynamic pricing informs investors and helps to allocate resources efficiently. That is for the second one. Third, it also provides the liquidity. So market provides the ability to buy and sell assets easily without causing big changes in price. Imagine you own shares in a company, and if you need cash, so you want to be able to sell those particular shares quickly. So financial market offers the platform on which it can be sold and liquidity can be achieved by selling that particular product. So to put this in perspective, as of 2023, the global market capitalization, the total value of all publicly traded companies was approximately about $106 trillion. This number underscores how massive and interconnected financial markets are worldwide. So before we jump into the specific types, does anyone have thoughts or experiences with the financial markets they'd like to share? So let's share some experiences. Maybe you have invested or heard news about the stock market fluctuations. So there are financial assets and asset by type, like equity markets are there. That means we are trying to differentiate, or we are trying to categorize the markets on the basis of asset type. The first one is equity market. So let's start by looking at financial markets based on the asset type, and the first one is, as we taught, that equity markets. So what are these equity markets? Equity markets or stock markets are actually the markets where ownership in the companies is bought and sold. When you buy a share of stock, you become a partial owner of that particular company, entitled to share of profits through dividends and potential capital gains if the stock price rises. So why to invest in equity? It is a question. So historically, equities have provided higher returns than other assets class over the long term, although they come with higher risk and volatility. So that's why if you want to go for the returns, you have to invest in the risky area, that is equity. So major equity markets in India are NSE, BSE. There are some worldwide markets, that is New York Stock Exchange, Nasdaq, the London Stock Exchange and others. These are often tracked by indices like S&P 500, FTSE 100 and Japanese, that is Nikkei 225, and in India it is Nifty and Sensex. For example, Apple, one of the largest companies listed on Nasdaq, had a market capitalization of about $2.75 trillion in 2024. This means if you added up the value of all its outstanding shares, that's the price investors were collectively willing to pay. So equity market also serves as an important signaling role. Stock price reflect investor confidence and expectations about the company's future prospects. But equities can be volatile also. Price can swing due to economic news. We can see that the economic news affect the price, geopolitical events or changes in company performance. So investing in stock requires understanding both the potential rewards as well as the risk associated with this particular returns. So most of the you or people doing with respect to the markets may follow the markets also. So you can also watch the company's favorite to you on the stock market, how the price are going and when to buy, when to sell the shares. Okay. So in this asset type, the second one is fixed income markets. What are these fixed income markets? So moving on this particular market, let's look at a fixed income markets where debt instruments are traded. So what are these debt instruments and how it is traded? So unlike equities, bonds also represent a loan from the investor to the issuer. Issuer are the companies, those who issues the bonds, whether government or corporation. In return, investors receive regular interest payments that are known as coupon or interests, and their principal back at maturity. So fixed income is often considered safer than the equities because bondholders are paid before shareholders or in case of company bankruptcy. However, bonds also have the risk like interest rate risk, interest rate changes or issuer default may be there. So the US Treasury market is the largest fixed income global valued at around $25 trillion. So when investors buy US Treasury bonds, they effectively lending money to the US government, which is considered very low risk. Okay. And we have a data, we can say that the 10-year US Treasury bills yield is especially important because it serves as a benchmark for interest rates worldwide. When it goes up or down, it influences the borrowing cost for every one thing from mortgages to corporate banks or corporate loans. So corporate bonds are actually the municipal bonds make up other large parts of the fixed income market. The second one is corporate bonds, offering higher yields but also higher risk as compared to the government bonds. The first one was government bond, second one is corporate bonds. So this market plays a crucial role in stabilizing the portfolios and providing predictable income, especially for the retirees or conservative investors. So any one of you or you might be have invested in the bonds. So we need to understand while investing in the bonds, what are the coupon payments, what is the maturity type or what is the tenure of maturity. Again, the third type in the asset type is money markets. So what are these money markets? Next, money markets deal with very short term debt instrument, usually with maturity of less than 1 year actually. Okay. So these instruments are highly liquid and considered very safe, making them ideal for managing short term cash. These are the money market instruments actually. Okay, and flexible or required for the purpose of short term cash needs. Common money market instruments includes like what we can say treasury bills, which are actually the short term government debt instruments, okay, and on which the interest is earned. Commercial paper is also an instrument of the money market which is issued by the corporations to meet short term funds needs or short term funding needs. Commercial papers can be issued. One more instrument like certificates of deposits, which are issued by the banks, and insured deposits are also there. Commercial papers market in US is alone about 1.2 trillion size, showing the scale of the short term borrowings and lending. Okay. So these are some basically money market instruments usually trade in the market. So money markets are actually important for the businesses. Why? Because they manage their working capital. Okay, so money markets are required to manage the working capital, and for investors seeking low risk places to park cash temporarily basis pe. Okay, though they offer lower returns than stock or bonds, but money market instruments provide safety and liquidity, often used as a cash equivalent. That's what the feature of the money market or what the instruments offer over here. So what we come till now, money markets and other types of markets. There are some more similar instruments which can be used for the purpose of investment strategies in money markets, which are money market funds are also there. So coming to the by structure, as far as structures we compare the markets. So first one is primary market. So now let's focus from asset type to the market structures types, and the primary markets are actually those markets where new securities are issued for the first time. This is the market for initial public offerings, that is IPO, bond issuance and other capital raising events also. So primary market was for the purpose of capital issuing. For instance, when a private company decides to go public, it sells shares to investors in an IPO. IPO stands here for initial public offering and raising funds for expansion. So, one landmark IPO was Saudi Aramco's in 2019, which raised approx $25.6 billion, and it was the largest IPO ever recorded. So, investment banks play a crucial role in the primary market by underwriting the issuance. This means they buy the securities from the issuer and resell them to the investors, and helping set the price and ensuring compliance with the regulations. That is what the primary market. So, primary market are basically essentials for economic growth because they provide fresh capital to businesses and government also. That is why the primary markets are essentials for economic development. So, we used to invest to the people, to those who have the investment strategies, they also go for the IPOs, initial public offers, where they want to invest to get the more returns. Okay, so it is also an instrument which is traded in the primary market. Now, the secondary market, that is what or the by structure, the second one is known as secondary markets. So, what are these secondary markets? After the securities are issued, they usually trade in the secondary market. So, trading goes on in the secondary market. So, this is where most investors buy and sell stocks, bonds and other instruments after the initial issuance. So, once they are issued, thereafter it is traded in the secondary markets. So, Indian stock exchanges are there, that is NSE, BSE, and the New York Stock Exchange is also there. There are so many stock exchange of the different companies, and these stock markets provides the data regarding stocks traded daily and highlights immense liquidity and volume. So, secondary market performs two critical functions actually. Firstly, providing liquidity and enabling the price discovery. Liquidity means that investors can sell their holdings quickly without waiting for a buyer, and price discovery happens as a supply and demand forces. So, constantly adjusting the prices to reflect new information and market sentiments. That is what done by the secondary market. So, without active secondary markets, investor will be reluctant to buy securities initially because they couldn't easily convert them into the cash. That is why the secondary market is also required. And this market, that is what the secondary market allows for speculation and hedging, contributing to the market efficiency. Okay, so these are some functions, that is speculation and hedging, which can be done in the secondary market. So, whatsoever we trade, securities, bonds, these are usually traded in the secondary market. So, on the basis of geography also, the markets can be categorized as domestic as well as international markets. Okay. So, finally, let us consider geography, and on the basis of this geography of the country, the markets can be domestic operating markets within a single country, or international markets or international cross borders and involving multiple currencies and multiple regulations too. So, these can be the various types of markets. Domestic markets are actually typically easier to access and understand due to familiar regulations and currency. Okay. So, international markets however offer variety or diversification by spreading investment risk across different economies and industries. Okay. That is what the markets on the basis of location. So international markets also offers challenges such as currency risk, political risk, differing accounting standards or differences in accounting standards, but it also open access to faster growing markets or unique opportunities. For example, emerging markets like India or Brazil can offer higher growth but with great volatility. So if growth is there, volatility will be there. So diversifying geographically can improve portfolio, but it requires careful research and sometimes professional advice is also required for the maintenance of this particular portfolios fruitful or profitable. Okay, so till now we covered the various types of markets, or on the basis of these bifurcations we can have the markets that we discussed till now. So in conclusion we can say that navigating the financial landscapes. To conclude, financial markets come in many shapes and many sizes, that is classified by asset type, structure and geography. Okay. So understanding these classifications of markets equips the students or the investors to make smarter investing decisions and navigate the financial landscape more confidently. Each market has its own risk return profile, liquidity and purpose. Equities offer growth potential but more volatility. Fixed income market provides steady income but with different risk. Money markets offer safety and liquidity. Primary markets fuel economy growth by raising new capital, while secondary market provides liquidity and continuous price information. Now the domestic markets are familiar and accessible, while on the other hand international markets offer diversification opportunities for the different types of portfolio. So in this session, the key takeaway of the particular session is that keeping learning and diversify your investment to manage risk efficiently. Thank you for today. I will see you in the next session with other some topics. Thank you.